How's it going, everybody? Welcome back to Smart Money, Smarter Moves with your host, myself, Sameer, our Director of Freedom Family Office, and our Chief Investment Officer, Cain. We are back to you with another week and another episode of this podcast that helps you make smarter moves because we believe that whether you're a client or not, you should be educated, and it's great to learn from our CIO, Cain. So, Kyle, what are you seeing, high level this last week? I know since the last podcast, there's been some changes, some recoveries in the market. What are you seeing this week?
So yeah, I mean it's where we're sitting here just after Valentine's Day. S&P 500's negative on the year, but it's definitely a tale of kind of two stories within the market where there's just been a big rotation. Even though the S&P 500 is pretty flat, there's certain areas that have been hurt pretty hard. Let's say software stocks, and the thought here, which we've seen recently, is just some new things. Anthropic being one of the big ones that came out with a few different AI agent type things that have to do with legal and financial services. So we've seen certain sectors and industry, the markets and investors are trying to look through like, all right, what in the future, even though right now they have good earnings, what in the future is going to be killed? What's going to be disrupted through AI? So software is obviously a big one where AI can replicate some of the stuff that software is currently doing. However, it's a hard decision on what to do there. I think definitely some of these companies are being punished. I think everything's getting thrown out for not good reason. A lot of these companies are going to exist and they're going to be extremely profitable. They still need, companies still need someone to come in and actually use the AI service to work more directly with their data. So I don't think it's the end all be all there, but it is still like, investors just kind of sell now, ask questions later. So there could be some good buying opportunities, but you have to be very diligent on which ones are going to actually be the winners. We've seen it play out just the past week in some other areas. We saw a certain financial firm, custodian, altruist come out with some tax planning on their custodian services, AI tax planning strategies. I mean, it's not really anything new, and it's not going to be a disruptor for the other Schwabs and the LPLs and the other big custodians, but they all sold off 7 to 12% just from hearing that news. The trucking industry just got a little announcement. They sold off 7, 10% in a week. So ultimately, it's kind of a little of the story of the have and have-nots. I think obviously what majority of investors should do in this environment is still do your due diligence, try to find which ones are going to be winners in this. Look at valuations. We're no longer just only rewarding growth stories. We are looking now at the actual valuations we're paying for it, but still focus on who are going to be the AI stack that we know is not going to be disrupted, and the huge amount of spend that we're seeing from the hyperscalers. Where is that going to go in the stack? Keep a lot of your focus and money there. But again, as cliche as it always sounds, it's diversification, right? There's plenty of other factors, geopolitics, the dollar, what's happening in Japan. So, diversify into other segments as well so that you don't, you're not just living and dying off of semiconductors or software or something that could be disrupted tomorrow.
Yeah, no, that makes sense. And you mentioned Anthropic and some of these AI things. I don't know if you saw in China, they released their version of Sea Dance, which is like these AI movies that looks really Hollywood like. It's kind of crazy. I don't know if you have any thoughts on that if you saw it, but as a second part, full disclosure, this is not investment advice. It's just educational purposes only. But do you think any part of AI, the sector as a whole, is in a bubble?
So yes and no. I mean, there's definitely valuation and money being thrown at just, out there after everything AI related, and some are going to win, some are going to lose. And just like the internet, when it came out, some of the winners at the time were disrupted and people that we had, never really heard of that much took over. That could happen now. NVIDIA may not be the winner forever. We don't know. I mean, I think they have a pretty good stranglehold right now on a big portion of it. Um, but yeah, like cheaper, better innovation, especially in something like this, can be upended so quickly that you have to diversify. You have to keep looking. I mean, I think we know that the U.S. is probably still far far above and ahead most of the rest of the world, but they could catch up quickly and could be cheaper. So I think just even that, if you still believe in AI, which I do, and I think there's still going to be tons and tons of money made, and but there's still going to be tons of money lost. It's look at areas where valuations, again, some Asian countries, their AI, if you want to diversify into some of those, what you're basically doing is still playing the AI trade, but at a lower valuation. They're cheaper than the US companies. So diversify some of your money over there. They could be winners too. So the answer, yeah, it's yes and no. It's hard to say right now, who's going to be the winners and losers. I think that's why the clearest way is to look at, again, all the things, the energy, um, you know, the semiconductors, all the things that have to be put into data centers, and there's so many different building blocks to creating all of this. Money's still going that way. So again, as long as you're not paying crazy valuations for them, it makes sense to add some money there.
Right. And the last question I wanted to ask you is, the Chipotle CEO, which has been a popular stock in terms of CNBC and news, talked about that the majority of people that come into Chipotle are six-figure earners that are actually eating at Chipotle. And that's part of the reason that they struggle is you attract a certain type of demographic. Overall, I hear mixed things. On one side, you hear from the office, the White House, that the economy is doing amazing. And then on the other side, you'll hear like people can't go to Chipotle anymore. What do you see on a macro level? Is the economy in good shape? Take out just valuations, or do you see some underlying issues?
Um, Also a difficult one to answer because we definitely are getting mixed data. We've, the past several years, things have been economic data and resiliency from the U.S. led by the U.S. consumer has been a lot better than we would expected. Spending every time we keep thinking that tariffs are going to take a big role into the spending, or we start looking at credit card default rates and things going up, and student loans are came back up into that individuals started to start paying back their student loans. That was going to be the next thing to kill the U.S. consumer. Yet we've been continued to be resilient. Last week, we just got a few important reports. We did get the retail sales data. It did show, retail sales grew less than expected, and we've seen the savings rate come down. And saving rate means that individuals are pulling into their savings to keep up their spending, and that can only last for so long. On top of that, we saw that the employment data, every January they do a revision. Not only just report what the actual January data was, but they do a revision of the previous year. And past several years, there's been big revisions. But last year, as of right now, it's estimated that only 181,000 jobs were created throughout the entire year, which is the lowest it's ever been outside of recession. So, there are concerns on the employment side. So you get, weaker consumer spending, lower employment, and we're in this sort of cake-shaped economy where everyone says that it's really the ultra wealthy that's holding up the spending. Well, again, you get a valuation concern and you get a stock market sell-off that could easily push the economy into a recession. However, on the flip side, right, here's what I ultimately think. I think that, yes, I mean, there was big spending. Individuals right now may be replenishing some of their savings, so their spending might drop a little bit, but pretty soon they're going to get refunds from the one big beautiful bill. Businesses haven't been hiring over this past year. There's been tons of political upheaval with tariffs and what's going to happen. So they didn't want to make huge, big investments besides those going directly into, the mega caps, the hyperscalers spending in AI because they were sitting on tons of cash. But besides them, not many businesses were wanting to go out and, take on new workforce, especially after they've loaded up over the past few years after COVID. So it all makes sense. I think now with the one big beautiful bill, some of this tariff uncertainty, even though it's not completely gone, I think it's going to become less of a headwind this year. The immediate expensing and R&D should help businesses want to start at least not lay off people as much, but I also think they're actually going to start hiring some more individuals this year. And the one big beautiful bill is going to help consumers' balance sheets with the refunds. So I think we're going to start to see employment steady and we're going to see retail sales start to pick up, maybe second half of the year. So ultimately, I'm still bullish that we're not in a deteriorating standpoint. Inflation data came out last week, a lot better than expected, although I still think it's going to rise, over the next several months. We still may be able to get some interest rate cuts when the new Fed comes in. So you put all those together, it's a mixed picture, but I'm still ultimately bullish that things are going to steady and start to tick back up here in the second part of the year.
Yeah, no, that's great. I appreciate the level of honesty and the fact that, there's two ways to look at where the economy's at. So I appreciate that, Kyle. That is for this week's segment of Smart Money, Smarter Moves. We will be back next week with an update. I think, Kyle, you're not seeing, are there any, by the time this comes out this week, is there any economic data you are looking for this week?
Um, Nothing. Most of the big stuff happened last week. This week, the main things are just kind of continuation of earnings, and so far it's been a really good earnings season. Like I said, investors are sort of looking past earnings a little bit and to what the future may hold. So trying to determine whether that's going to be a continued catalyst for, the rest of this quarter or so, or if earnings are going to, over resume some of the or relieve some of the fears. I would say as we get Nvidia's earnings coming up pretty soon. So we've got a few other big earnings to look out for. So that's what I'd be watching.
Thanks. Appreciate that, Kyle. Well, if you guys are interested in Freedom Family Office, go to freedomfamilyoffice.com, or you can reach out to Sameer at Freedom Family Office and we can send you a free copy of Kyle's book, Smart Money, Smarter Moves. But we'll see you guys next week. And thank you for becoming smarter by listening to Smart Money, Smarter Moves. Thanks, Kyle.
Thank you.